Ladies and gentlemen, there's a bloodbath in the stock market yesterday, and it's important for us to take a look what has happened and what should we do about it. Let's watch on. So we have seen a bloodbath in the stock market. The Federal Reserve have cut interest rate, but strangely, the stock market crashed. And I know a lot of people are going to say, Mr. Lu, no, 2, 3%, 4% is not a crash. But trust me, one day of this kind of magnitude is very serious. But let's take a look, shall we? As usual, these are my usual disclaimers. This is not financial advice and specifically not telling you buy or sell. This is what I do and for entertainment and for education. Thank you. So the Federal Reserve had cut interest rate by 25 basis points, 0.25%. This has brought interest rate down, the Fed fund rate down to 4.2 to 4.5%. And it was in line with what everybody expected. But however, the stock market crashed, right? The S&P 500 fell by 3% and the Nasdaq fell by 3.6%. And so did the Dow Jones Index and also the TLT, which is the bonds. So the question right now is that, how come I thought cutting interest rate is a good thing and why the stock market crashed? Traditionally, cutting interest rate is always good for stocks because the cost of borrowing actually lowers and people has more money to spend and things like that. Company has lowered their borrowing costs and therefore there are more profits. So by right, stock prices usually goes up when interest rate cut. But so what has happened? Well, this is largely because Jerome Powell, the Federal Reserve Chairman, actually said the following, that with today's action, we have lowered our policy rate by 1 full percentage point from its peak. And our policy stance now is significantly less restrictive. We can therefore be more cautious as we consider further adjustment to our policy rate. In short, future rate cuts are probably going to be less. That's what it's basically saying. They will be more cautious about future rate cuts. So while people are happy that there is a 25% interest rate cut, but in future, there'll be less interest rate cut, and that's something that people is not expecting. So unexpected shock like this is bad for the stock market. So the Federal Reserve Committee regularly do what we call a summary of economic projection, and basically get everybody to do a dot plot, meaning that they do their forecast where they think the interest rate direction should be. In September, when they do a dot plot, means get everybody to do a prediction, most of them predicted 4 interest rate cuts, okay, of 25 basis points. But right now, in the December dot plot, the committee only projected 2 interest rate cuts. And therefore, this is a shock to the market because interest rate cuts are going to slow down. And therefore, in that sense, the cost of borrowing is going to go down at a slower pace. And this is bad for the stock market. So as analysts look at this thing, the stock market is not looking at the present. The stock market is looking at the future. It's a forward-looking market right now. It's basically totally discarded the good news about the 25 basis point cut that's happened yesterday and focus in future. Unfortunately, there will be less interest rate cut for the next year. This is something that investors and analysts are not happy about, and they beat down the stock prices. Lesser interest rate cuts means that the lesser interest rate cut is in reaction to what the Federal Reserve anticipate, that the higher inflation is probably going to stay for longer. This slower rate cut is in response to what they view as the inflation rate going down slower than expected. So inflation rate right now is a lot stickier. Therefore, interest rate cut is expected to be lesser. This makes things about more expensive when you're talking about funding and borrowing and things like that. And it all hurts stock valuation. This is something that spooked the market, and certainly it's hurting the stock market. Other analysts also say that stock prices are a lot expensive right now, especially tech stock, where there are huge profits sitting on by many people. And therefore, ahead of holidays, we better lock in the profits right now. There's massive selling and sell it, make a lot of money, and so that next year, they have a better year. This is also massive profit taking in view of an escalation of risk. There are also analysts that say that the market is probably overreacting. This analyst from Jenny Montgomery Scott is actually saying that the market is factoring something that shouldn't have been known but not fully baked in. I think it's a bit of an overreaction. a knee-jerk move off, something should have been known. It isn't like the market was shocked by indication of just one cut next year. So it seems overdone. I also have the same reaction. I think there's some overreaction on this part. So a similar experience has happened in history before. I'm sure there are much more. The one that's more prominent back in my memory is somewhere in 2002 and 2003. So a similar experience have happened before many years ago, somewhere around 2003. So the Federal Reserve, since the dot-com bust, there was a terrible market crash. So they did 11 rate cuts to try to revive the economy and the stock market. So they did just once in 2002 and another time in 2003 because they worried that the economic recovery was not happening. So in June 25th, 2003, they cut by 25 basis points, and in November 6th, they cut by 50% basis points. So what was interesting was the interest rate cut of the 25 basis points. So the market was then expecting a 50% basis point, but they cut eventually only 25 basis points, and it disappointed the market. The interest rate cut was less than expected, and the whole market was disappointed. And as a result, the stock market was punished. It went down, not by a lot, by roughly about 0.8% or things like that. And in the next day, it recovered. I expect something similar to happen, but never 100%. That, the initial reaction that we see right now should go away in time to come, and the market will eventually recover. Now, is it 1 day, 2 days, or 5 days, or 1 week or 2 weeks? I don't know. But I think the overreaction of the market, in my opinion, will eventually go away. This kind of overreaction has happened before. At the September meeting, the Federal Reserve cut the interest rate more than expected, but yet the market also initially tanked. So this is not surprising. Right? That's something that's happened before. So at the November meeting, the Federal Reserve cut interest rate in line with expectation and the market rallied. Interest rate movement for the first few days is something kind of difficult to anticipate in the reaction. So we probably have to see a few days to understand the full market response to all these interest rate cuts and the expectation of it. So in short, it's all about expectation. The interest rate cut yesterday was in line with expectation, but the expectation of what's going to happen for next year has changed. The market is responding according to it. And over time, things might change depending on how inflation rate goes up and down as well. I've been warning myself that a risk of a crash has elevated. So that is why I've been telling myself again and again in my videos that I'm doing some rebalancing to make sure I de-risk myself from this kind of possibility. This event really highlight the risk of this kind of thing happening. That said, what has happened so far is not in response to a re-inflation risk. That means inflation did not spike in a significant way. So therefore, there is probably not a risk of interest rate hike. If there is one, then that is going to be very painful to the entire stock market. So at this juncture, I don't think I need to overreact, and I actually will just watch and see how the market will respond. I, in the opinion that in the midterm and long term, the trajectory of the interest rate movement is going to be now. And I think in the mid to long term, the inflation movement will be highly dependent on what's happening according to policies that Trump administration do. I think we should then reevaluate the assessment of it. So currently right now, I don't think I need to overreact, but I should adopt a wait and see approach and see what's happening. I'll just stand back and watch for a little while. I'm not selling, I'm not buying. But if the market does crash significantly, I've been catering some ammunition through my rebalancing. If the market does crash, I'll go back and whack onto it. But certainly right now, I'm not selling anything. Market volatility of this form is something that is part and parcel of investment. And I'm a true believer that if I invest in a globally diversified index like S&P 500 or NASDAQ or equivalent, the long-term trajectory will still go upwards with some volatility in between. This is part of volatility. There are people who cannot stomach volatility and overreact. I cannot stop you, but for me, I think I'm just going to hold on and see how it goes up and down. And I believe that in the long term, 10, 15, 20 years, we'll still have a trajectory that going up. I just got to live through some of this volatility. I'm not telling what to do, but this is what Mr. Lu is doing. Thanks for watching. We're happy to discuss your view. I'll see you in a day or two. Bye-bye.